Hello and welcome to Big Deal. I'm Nisha Poddar. Now, Ghar Wapsi theme is gaining momentum in the startup space in the midst of several headwinds faced by the new age digital companies. Now, Ghar Wapsi is essentially domiciling back to India those startups which are founded by the Indians operating in Indian market presently but incorporated overseas. And this can be done through a process of reverse flipping. But this is not an easy structure, nor is it tax efficient, and the startups seek government support along with also tax dispensations. Gift City has stepped in as a possible solution, and the IFSCA committee has made recommendations to the government on simple reverse flipping to Gift City as an option. Let's delve deep into this particular topic and how the industry players see it. Siddharth Pai of 314 Capital, Mitul Mehta of Bloom Ventures, and Ajay Roti from Tax Compass. All of them join us for this discussion. Thank you, gentlemen. Always welcome to CNBC-TV18. Now, Siddharth, you're a member of that IFSCA committee. Let's begin with what are those measures that have been suggested to the government for the reverse flipping to happen in the Gift City?
So thank you very much, Tesha. One of the things we actually spoke about at the committee quite often is what is the kind of changes we need to see from an Indian regulation perspective in order to attract these companies back. I think PhonePe actually set the ball rolling by actually paying close to $1 billion in terms of tax, but I don't believe many of the startups end up having that sort of fiscal space on their balance sheet to end up making that sort of contribution as of now. So one of the things we actually base the entire archetype is from a tax perspective. The government of India in 2021 created a scheme for foreign funds who invest into India to redomicile to Gift in a tax-free fashion. So we've actually taken a leaf out of that playbook and created a similar kind of framework for Indian companies or holding companies overseas to end up actually redomiciling back to India without paying any capital gains tax, income from other sources, or any other associated taxes that actually ends up coming with that entire piece. So that's actually one part to end up actually getting that entire thing through. The second thing that we've actually seen over there that we need to end up doing is to make sure that the kind of incentives and the kind of operating leeway that was given to these companies overseas is similarly replicated in Gift IFSC as of now. So to make sure that some of the frameworks regarding corporate law, frameworks regarding giving of ESOPs, not just to employees, but to vendors, to consultants, and to professionals as well for that matter, creating a separate framework when it comes to corporate litigation, and to make sure there's a separate litigation practice and a separate system, separate judicial system that ends up applying over there becomes important. The third part that becomes important as well is, since Gift IFSC is relatively new, what are the kind of measures that the city needs to end up actually undertaking to make sure that quality of life can end up attracting people not just from India but from overseas as well into Gift itself. The next, when it came to capital raising, also to make sure that the process of capital raising in Gift is something that's more attuned to what you see overseas. So creation of SPACs when it comes to Gift IFSC, making sure that they actually have access to hybrid instruments also for that matter, that can end up actually converting into various forms and are more attuned to what investors expect when they invest into a Singapore or a Delaware or something for that particular matter. And the last set actually becomes the operating changes to Indian regulations to make sure that all this can actually end up going through. So we've already based it into 5 buckets as of now, because the purpose of the committee was to make sure that the report is comprehensive. Because in these sort of large-scale situations, if one of the bodies of law, one of the acts are not actually amended, it may end up undoing the entire thing. So we spent substantial amount of time to go through the entire transaction chain, identify these areas, end up actually giving suggestions along those lines itself.
So, Siddharth, what has been the government's response to it, to these recommendations?
So the report has been very, very warmly received by the government as of now. Based on discussions we've had with the secretaries, with various people as well, they were very happy to see the report and the kind of sessions that have actually come about, because it has set a framework now that the government needs to end up actually exploring to make sure that they can decide what are the elements they can incorporate as of now, what can you do in the medium term, what can you do in the long term, etc. So one of the things that the government has been very outspoken about is the fact that we need Indian startups to actually come back to India. India should be a land of startups, not of subsidiaries. And this particular report will ensure that the majority of India's unicorns who are overseas have a particular glide path to come back to India. And the next set of companies who are also unicorns or companies or entrepreneurs looking to incorporate their company will end up choosing India as opposed to choosing a foreign jurisdiction when the bulk of their market remains in India itself.
All right, so that's a great attempt by the IFSCA and warm response from the government as well. That's what Siddharth Pai has shared. But I want to understand from the VC community perspective, because a lot of things that the startups and the unicorns do are really guided by the investor community who are so heavily invested in them. So Mitul, what do you make of this IFSCA flipping as an option?
Sure. So I think it's definitely good steps. I think the report is very well put out and thought through. From our perspective, as VCs, I would categorize investors in two buckets. One is the SEBI-registered funds, and others is non-resident investors. So typically, for SEBI-registered funds, we have to go through a certain process for investing outside India. Now, in case of companies that are domiciled in GIFT, for us, the report, of course, has recommended an exemption, but for us as VCs today, we have a certain cap on the fund size beyond which we can't invest in companies domiciled outside India. So for us, I think till we don't have that the neutrality or the exception, we are probably indifferent. But for the global ecosystem, yes, it opens up an eventuality for investment in GIFT IFSC for sure. I see it taking some time. I don't think there will be immediate movement because the ecosystem is yet to develop. So maybe it will start with fintech companies, edtech companies. These are the sectors that IFSC is focusing on. But with that, what is also important is the ecosystem. So a lot of these companies coming back are primarily coming back to list on Indian exchanges. Now, at GIFT IFSC, the exchange is still at a nascent stage. And of course, as it grows, that becomes a viable option as well. So we would think of it that way. I think right steps in the good direction, but I think it will take some time to kind of eventualize it.
All right. So wait and watch and see how that really evolves. Ajay Roti, what do you think of the IFSCA measures that have been presented? And what do you think is the core of this issue in reverse flipping when it comes to tax efficiency? Where does that particular matter lie?
Nisha, I think one of the most important considerations is really the tax consideration. And like Siddharth mentioned, if you see the tax bill that phone pay to foot, then you know what's the quantum of taxes that are involved. There are 3-4 aspects when it comes to tax. One is really the one-time exit tax or the tax that you incur to flip your structure, which essentially means, there's a overseas holding company in which there are shareholders. They give up those shares and get shares in an Indian company. Therefore, there's a transfer. You can do it as a part of a cross-border merger. In some cases, that will be tax neutral, not in all cases. That's one large bucket, which is really the tax in the hands of the shareholder at the time of the reverse flipping. Second is really the Indian companies in a lot of these cases would have losses. And there is a provision in the Income Tax Act which prohibits carry forward of losses if there's a change in shareholding beyond 51%, very simply put. So that's another piece where there will be a leakage. And the third is the transfer pricing and other aspects, FEMA, ODI. These are really the big key tax considerations. Now, what does the IFSCA report do? I personally think it's a brilliant report in terms of identifying all issues that could possibly come up. And there is a solution, there is a proposal as to how some of these could be negated in all cases. So they have suggested tax neutral flipping, a one-time exemption for the flip that happens, exemption from this carry forward loss that you would lose, therefore permit the carry forward losses to be eligible for carrying it forward and set off later if you flip into IFSCA. I think the IFSC regulations, the changes that are proposed are very good. But what needs to be done is, in addition to these tax changes, there are also certain other regulatory changes which are again being highlighted in the report, whether it's the ODI thing, whether it's for listing. These also have to be done together. If all of those are not done, then it doesn't become a viable option. We can't do this in parts. There can't be half measures. We can't have only a tax neutral flip, but not address other aspects relating to overseas direct investments or listing regulations and things like that, or ESOP for employees, for example, or investment by residents into those companies.
That's
so it has
right.
to be seen as a whole, and the report has to be considered in toto, in my view.
All right, so a lot of overhaul is really needed for tax efficiency as well as also to give it the benefits of being re-domiciled. So we'll discuss a few of those technicalities when we are back after a very short break. But remember that a lot of startups want to come back with an IPO mandate. We'll focus on that particular aspect as well when we return. Stay tuned to Big Deal. Welcome back. You're watching Big Deal and we are discussing the reverse flipping aspect by the startups. So Mitul, we did discuss the IFSCA measures and the tax efficiency that is required. But a lot of startups want to come back to India, re-domicile on the mainland because of the IPO as a prospect. As an investor, what are the suggestions that you are giving to your portfolio companies who have this particular mandate of an IPO exit for the investors? And on the other hand, how do you see this panning out and the time limit in which the reverse flipping can be done tax efficiently?
So IPO, I think, has turned out to be a really good option that we see, at least in the medium to long term. We've had a couple of our portfolio companies successfully list on the SME exchange. We have likes of Paytm, Nykaa, etc., that have gone on the main bourse. So a lot of these companies that were domiciled outside, who essentially have India customer bases, India operations, India team, and don't really have too much outside. I think for them, it's a really good strategy. I think the one other thing that we've also had discussions with our portfolio on is the whole valuation aspects, right? So a company at a $250 million, $500 million, $1 billion valuation may not be very significant on a stock exchange, let's say in the US, but if someone comes and lists in India, there is a decent prospect that they would have. There is an increased attention on the space, on the tech space. There is interest that is coming in from HNIs or the investors that would typically invest in real estate and listed entities, and all of a sudden they're seeing a lot of activity happening on the startup space. So I think it is definitely a good option. We have been very big proponents with our IPO. In fact, we've for the last year and a half or so, the team has been having various conversations with companies that are on the path to IPO, is what we are calling them. From a time frame perspective, yes, reverse externalization or reverse flipping will take some time, but I don't think the IPO market is running away. Even if it takes 12 months, 15 months, 18 months as outer limits, there are still prospects for sure. I don't think that would be a big hindrance. The faster it happens, the better, the clearer the regulations are, it will help. But I don't think that would be a very, very big constraining factor.
But Mitul, the way the markets have behaved in this particular week itself and the pressure that we have seen on the valuations, we'll have to see. I mean, there's no hurry to do an IPO probably at this time. But I would pinpoint one thing. This whole flip-flop of flipping and reverse flipping has happened in a very short period of time. And the market is very cyclical. Even though the markets present good opportunities today here, the US markets could also become buoyant in some time. Having said that, Ajay Roti, do you think 12 to 15 months is a rational timeline to look forward to? What are those discussions that you're having with your clients? And are there enough solutions to the tax efficiency bit also? Do you think some of the reverse flippings taking shape in a year's time?
Nisha, that's an interesting question. And the reason is, and I'll just take it from where you left, which is the flip-flop happening and a lot of flips happen and then a reverse flip. I think here the first thing, and that's something that I've been seeing when I'm talking to my clients, is there's no one shoe that fits all kind of a solution. So it's not that everybody has to flip back or reverse flip. I think that's the first thing. It works for certain cases. It may not in certain cases, not just for tax reasons, but also other commercial reasons. Now, coming back to tax efficiency of flipping, yes, there are efficient ways of doing it. And there is a need to do a few more things from a tax regulation perspective to make it tax efficient. One easy way or tax efficient way is really to do a cross-border merging it into Indian company, and therefore there are certain exemptions available for it to be a tax neutral merger if certain conditions are fulfilled. Now, the only problem is that's not going to happen in a quick timeline because you need multiple approvals for that. You may even need a RBI approval in case you don't really, fall into the cross-border merger automatic route, if we can call that, regulations that RBI has issued. So therefore, you could do that. Swap is another option which can be achieved quickly, which is you really swap the shares, but that leads to a taxable event in India, and not just in India, possibly in the host country as well. So there will be aspects of double taxation, credits, etc., that come in. So there's again no simple answer here as to whether the flip back or the reverse flipping can be done. But there are options which can be considered. But it's again a choice between a timeline that you're looking at and making it tax efficient. A tax efficient option to be done in 12 to 18 months is you're running against the clock there.
All right. And away from the IFSCA committee, Siddharth, wearing your investor hat and somebody who knows the startup space so well, what do you have to say about the fintech push, apart from other regulators also involved in the reverse flipping and giving dispensation for that or making some changes? RBI also plays a very big role. So fintech, sector has the most number of aspirants for reverse flipping. How do you see the scenario and what are the challenges there?
No, Nisha, that's actually a fantastic question because I think we've seen a number of our fintech unicorns have also chosen to domicile overseas. And many of them are actually facing issues right now in terms of actually getting their licenses within India itself. Indian regulations actually requires that the foreign company which is in financial services to also be regulated. Whereas foreign regulations also at times may not end up actually regulating, the company may end up actually regulating a subsidiary for that matter. So I think these sort of friction points and this sort of dissonance between regulation end up becoming a major issue for a number of fintechs who've actually flipped overseas and they're looking to end up standing and operating in India as of now. So one of the things I think that's going to be most important, because IFSCA is also a fellow Indian financial services regulator, I think one of the things that's also there is in case the companies are actually domiciled in GIFT, for that matter, the fit and proper criteria, some of the checks that are required from an Indian perspective, from PLA perspective, should hopefully also end up being relied on by the Indian regulators when these companies look to actually end up creating their Indian subsidiaries and look at getting Indian licenses itself. I think we've actually seen of late a number of just as an example, it may not be related to this, but just as an example, a few of the companies who applied for the PAPG licenses as well as an NBFC licenses have actually seen their licenses being put on hold because they actually have foreign overseas structures. So it actually takes time for the Indian regulators, be it RBI or SEBI, to end up going deeper into this entire place, start looking at the fit and proper criteria of all the people over there, look at the UBOs who end up existing over there itself. So I think if these companies are actually domiciled in GIFT, some of these issues can end up actually being relied upon, and the work and the turnaround time can end up actually reducing to a large extent itself. Because some of the thesis for having a foreign overseas entity, when your market is in India, you're working in the Indian financial markets, regulated by Indian financial regulator, some of this, that overseas entity becomes an added level of friction. So there's also a need for them to end up coming back. And from the regulatory standpoint, people are hoping that IFSCA being an Indian regulator, this reliance can actually be made. And the turnaround time for licenses can end up reducing, thereby making them a lot more nimble and a lot more agile as well.
That's right. In fact, Siddharth, on many various aspects, GIFT City and IFSCA have made some fabulous breakthroughs in getting a lot of regulators come together and give the clearances and dispensations required for increasing its traction. But we have to see in terms of the reverse flipping, how popular IFSCA is going to get. Mitul, what's your understanding? Mainland reverse flipping versus IFSCA with the various measures that can really come to the fore for dispensation for a faster reverse flipping in IFSCA versus mainland, which Ajay says is quite difficult and, it can be a long haul process. Given these two, what are the differences and what could be the choice at the moment?
So I think, both of them are in some sense untested. Yes, we've had cases of PhonePe. We have a couple of others that we've known in the news that are evaluating that. But the process of reverse flipping, whether it's mainland or IFSCA, today is unknown in some sense. It's not tested, right? So to that extent, I think they're similar. What I would say is different is IFSC, GIFT as an authority, have been very open and they have a primary objective of trying to expand that jurisdiction, right? So they may be more amenable or, they may have more attention on addressing issues So to that extent, I think it may be a little faster on the gift side. On choosing what jurisdiction, I think it'll largely depend on what the end objective is, right? So if the end objective is IPO in the mainland, then there is no choice. Everyone has to come to the mainland.
Exactly, Mitul. Yeah. So that's the main crux as well. So Siddharth, do you think some of those issues can be addressed where an IFSCA flip can also lead to an IPO, or Indian investors can also invest there? Can there be dispensations around that? How do you see this evolving?
Yeah, I think that is actually one of the points we debated rather heavily in the committee as well, for that matter, because as we know, since IFSCA is considered foreign jurisdiction, anyone who invests over there from India will have to go either the ODI, overseas investment route, or they have to go to the LRS route itself, for that matter. And there are very severe restrictions when it comes to investing foreign capital overseas, when that capital ends up actually coming back to India. So, round tripping has been clarified to a large extent. It may actually end up creating added friction over there, especially with the TCS on LRS, as well as several committees that have actually come about. So one of the things that we also propose, and it's a matter that's going to be discussed, is in case these companies actually domicile in GIFT, would it be possible for Indian investors, your Indian mutual funds, your institutional investors, family offices, HNIs, retail investors, to end up investing over there? Or can a dual listing happen where the companies list on the Indian mainland bourse and simultaneously on the GIFT IFSC exchange as well? So that way they end up actually being able to raise capital from foreign investors as well as from domestic investors without requiring large-scale changes when it comes to existing regulation itself. Because I think from the IPO perspective, the Indian companies will still have to end up actually raising money from Indian investors and to create that kind of buzz in India in order for them to become very successful. And for all the companies looking to redomicile back to India, listing on the Indian exchange and actually getting that sort of enthusiasm from Indian retail investors and other investors is a key impetus for them to decide to actually flip back to India.
All right. So, that point well made. Ajay, I have just 30 seconds. Any final comments you want to make on the challenges and how do you see that going forward? Because you're in the thick of the action and you're working on some of these cases as well.
I think, immediate response would be that the ball is in the government's court now, both in terms of the report that IFSCA has given and even otherwise, in the economic survey, there was a mention of reverse flipping. I think there has to be a enabling regulatory framework, both tax and otherwise, that has to be done. I think that's the need of the hour rather than anything else. And once those come in, then this will be, the Ghar Wapsi, as you called it, will be much easier and more tax efficient.
All right, gentlemen, very good points made there. A lot of insights on this hot topic of development in the startup space. But I must also state that I was in Delhi and I met some of the ministries and the Ghar Wapsi theme is very much on top of the mind for the government, and the industry is also baking in an expectation for some of those announcements to come in the budget as well. Let's see how this develops at the moment, but lots of loose ends here and lots of changes and dispensations that need to be there for the startups to re-domicile into the Indian market where they operate. Thank you so much, Siddharth, Mitul and Ajay, for joining us with your insights. With that, it's a wrap on this edition of Big Deal. Thanks so much for tuning in.